Well, retailer Clicks reported a 10.6% increase in full-year headline earnings per share and declared a dividend of 168 cents. So joining us now is company CEO David Kneale, and he, of course, is with Sam in Cape Town. Sam.
Yep. Well, just looking at those numbers further there for you, we've got group turnover, which was up 13.6%, and then we had the dividend, as you were saying, 10.5%. Return on equity, which is highlighted as a sector leader level, 55.6%. David, thanks for joining us here in Cape Town today. Let's just look at Clicks, which is essentially, of course, the key driver of earnings still and the large proportion of the overall group. Sales, they were up 8.6%. You added a net 22 new stores during the period. But if you look at comparable store sales, up 5.8%, I mean, that's pretty much in line with inflation right now. So you highlight the tough operating environment in South Africa. Talk to us about the growth that you were able to achieve.
Well, just a point, yes, the country's inflation is running at about 6%.
Yeah.
Our own selling price inflation is half of that, so 3%. So we've kept our prices down through the year in order to drive volume. So we still saw real volume growth in Clicks, and indeed encouragingly we had a better second half where our sales were up 10% as opposed to 7% in half one. So the consumer is undoubtedly under pressure, and I don't think that's going to change in the near term, but we're actually encouraged by the momentum in the Clicks chain.
So it's interesting there, as you say, you know, keeping inflation essentially low to keep market share. Has that been the strategy of you to be able to keep customers coming to Clicks, even as you have a situation where perhaps it could impact margin? I mean, our margins, is that a tough balancing act you're looking at right now?
Absolutely, it's a balancing act.
Yeah.
We actually grew our margin 30 basis points in the year, so we actually managed to improve our margin slightly, but you're quite right. Our big focus is on taking market share, strengthening our competitive position, and increasing our customer base, which I'm pleased to say we're doing.
David, looking at that pharmacy, healthcare, beauty mix that you have, and looking at the growth there, 442 stores is what you have now. You've had further growth this year. You're planning further growth. You've also been able to give a dividend, so there's money available to do these things. But 331 of those stores have in-store pharmacies, and that seems to be the thing that is perhaps the biggest selling proposition for Clicks.
Certainly, I think the chain is increasingly focused as a health and beauty business. But it's not just pharmacy. Our fastest growing category was actually front shop healthcare, because one of the trends we see is a trend to people self-medicating. So that business was actually the fastest growing business. So yes, we're a healthcare business, but it's total healthcare. It's not just prescription medicines.
So it's not just walking to the back of the Clicks there to get your prescription medicines or the likes. Interesting, as you say, trends in healthcare, you know, people self-medicating.
Yes.
What type of product ranges fit into that? And perhaps from a South African perspective, some of these obviously come with a premium. I mean, how much growth can you see from an area where we know South Africa is a different kind of demographic to the likes of the United States, where this area has been growing for some time?
Look, I mean, I think you're right. There is a premium. So what the sort of products we're talking about are supplementation, food supplementation, vitamins, sports nutrition, healthy foods. And I think some people are choosing actually to do that rather than visit the doctor. So I think that's one of the drivers of that trend. I think certainly, yes, the demographics of this country are different. So I think that is going to that does constrain the size of the market, but ultimately we think this will be a growing market.
So essentially you're increasing shelf space for this. I mean, what is kind of moving off the shelves to make space for more vitamins and gluten-free products?
Well, we're using the space more effectively in store. Typically it's the general merchandise part of the store, the homeware part of the store that is condensed in space to accommodate more health and beauty products.
David, just looking at the share activity, you've been very popular with Coronation in quite an unusual shift. They increased their stake in Clicks by 10%. There was a willing seller and they took that there. Also the PIC, 11% up to 15%. And you yourselves, you had a share purchase program which you announced at the beginning of your closed period, a buyback program. You did the same in February. What's behind that, and how far is that program? Are you going to get like BAT who buy their own shares every week?
Look, we've had a consistent policy now for 7 years that says we will return surplus cash to shareholders. We are a cash generative business. in the last 12 months, we generated 1 billion rand of cash. We are investing in the business, in new stores, in IT, in new warehousing, but we're returning surplus cash to shareholders. And buybacks is one of the ways in which we do that alongside dividends. So that's the commitment. And I think that's what makes Clicks a long-term investment, good investment proposition for a number of shareholders, both locally and internationally.
Just looking at CapEx that has been committed for 2014, sitting at 338 million rand. And interesting, you know, just talking off air, you're saying you're moving towards smaller format stores. Why that shift there? Why does that work? And what type of areas will these Clicks be located in?
Well, we're talking about more convenience stores. And I think particularly if you look around the Gauteng area and just the opportunity, if you like, to infill with more smaller shopping centres coming up, which I think is a trend that you see worldwide. People want more convenience when they shop.
Are we going to see you in an Engen or a Sasol or something like that, so like the Woolies and
I don't think we'll go that far, but yeah, we're certainly expanding the number of convenience stores that we have, the number of smaller stores.
David, just take us into the broader economic environment that we're in. Of course, yesterday you would have been interested in the Finance Minister's statement on the economy and where we can expect to be in the next few months to a year. What was your reaction there? We were saying earlier that if he hadn't been culling the perks of cabinet ministers, what would the headline have been? And I think if you take away that, it's been a bit of a mixed reaction. And as a CEO, what's your view of what the Finance Minister had to say?
I think pretty broadly our view is that the Finance Minister was saying that South Africa can expect another year of fairly anemic growth. And that's certainly the way in which we're planning the business. We think consumers are going to stay under pressure for a while.
From a business leader's perspective in South Africa, I mean, what was conspicuous by its absence in yesterday's speech? Well, what would you have liked the Finance Minister to perhaps stick his neck out on and say?
You're trying to drag me into politics, and I'm not going to be tempted.
Well, what do you think? What do you think is needed right now? I mean, just broadly, one thing that perhaps is needed to be spoken about more openly.
I think that the biggest issue is around job creation, and anything that hampers job creation, for example, the labour laws, is unhelpful to the economy in the medium term.